Buying a business to grow your business is the cheat code, but it's not for everybody. Hi, I'm Jared Krause. I'm host of the Buying Online Business podcast, and today I'm speaking with Michael Frankel, who is the founder and managing partner of Trajectory Capital. He has held C-level executive roles, corporate development, strategy and innovation, CFO and COO roles at large and small growth companies. He is a corporate development, innovation strategy, and corporate venture leader who has driven aggressive growth through expansion at global technology and information services, professional services companies including Deloitte, Lexis Nexis Group, IR, GE Capital, and VeriSign. And Michael has a track record of executing growth strategies and using acquisitions, ecosystems, and corporate venture investments. And he's been a part of over 110 deals across his career. And in this podcast episode, Michael and I break down why M&A is the cheat code to growing your business for a great exit or just for a great return and for a great holding company. We talk about what strategy, like what are the things you need to be thinking about if you are going to acquire a business and why. Michael comes from the standpoint similar to me, is like, this isn't for everybody and you should prove that you shouldn't be doing this. And if you can't, then you go down the M&A strategy and you acquire the right business. So thinking about strategically, what is the right business for you? We talk about how to work that out. Is it extra product? Is it team? Is it technology, services? Why should you be doing this? And how can it get you the best ROI for the business you already own? How is it going to help you grow your primary business? Then we talk about how do you finance it? What's the amount of capital that you can use? We talk a little bit about like financing and like different types of financing, different risks and different ways you can finance the business based on getting revenue from your primary business and then also using the revenue from the business you're acquiring and what that looks like, just assessing the risk for the lenders. We also talk about why an M&A advisor is worth their weight in gold and why you're crazy to go down this route yourself if you're trying to acquire a business, and just the certain skills and the certain risk prevention that an M&A advisor provides you when you're trying to acquire business and use the growth by acquisition strategy. This is such a fun, valuable podcast. Michael has a ton of experience. It's great to share that with you guys. I'm sure you're going to enjoy it, so dive in. Michael, welcome to the pod, and thanks so much for your time.
Thanks for having me.
Yeah. You've done your CFO, COO. What do you prefer mostly, CFO or COO, and why? And you've done it for a bunch of different brands, right?
Between those two, I prefer CFO. My favorite job is running corporate development. My favorite job is deal making. Mm-hmm. So because I love the radical change that you can drive. It's sort of a cheat code, if you will, right? Building a business from scratch is really hard work, where yesterday we didn't have this product line and we didn't have all these customers and revenue, and today we do. So yes, I'd say of those, corporate development first, and then CFO, but I'd say only to the extent it's a strategic CFO job. I've never been a bean counter. I don't find accounting that fascinating. So for me, the fun of being a CFO is being able to turn data into insights.
Yes.
Right? Come to the head of sales and go, let me explain what parts of your team are working and not and why, and providing that insight. So that, for me, that's the magic of a great CFO is they take a giant spreadsheet and they extract operational insight that makes everyone better at their job.
Yeah. And all like slim down expenses and reward people that are, incentives for people that are doing really good, or the marketing teams like, okay, this marketing, we're spending X amount on this marketing channel and it's getting a better ROI than say this other marketing channel. Like, why don't we just redivert like that capital?
Yeah. All those kinds of insights are buried in the data, right?
Exactly.
And especially if you get into, if people are rigorous in their sales process, you can get to time to close and number of meetings and effectiveness of different pitches. There's all kinds of really interesting things you can use to optimize pricing. So for me, that's what's fun about financial data is if you can come up with real world changes as a result of really digging into it.
Yeah, absolutely. I'm a big believer in what I call inside out growth. And if you just like, instead of trying to just hire people that it's like, oh, they're great at marketing and in this channel, they're great at Google ads or Meta ads, or they're great at TikTok or whatever it is. Let's just add, like, we need TikTok in the business. Like, what's the point when you look at the data and you go, oh, hang on a second, like Google ads are outperforming Meta ads and that's amazing data. Let's just grow from the inside out versus like creating a Frankenstein business with all this team and systems, unnecessary team, unnecessary systems.
Absolutely.
Really.
I think the question for almost any business decision, and it's triply so for M&A, is explain why this makes the company better. Whether it's we should have AI or we should do acquisitions or we should expand into this new market, none of those things are by definition good ideas. So let's step back, and this is an analogy that may not make sense to you if you haven't seen a lot of US television commercials in the 1970s, but there was an ad decrying drug use. And it said, this is your brain, and it showed you an egg, and then this is your brain on drugs, and it showed you an egg frying in a pan. But I use that analogy all the time, which is whatever business decision you're thinking about making, explain to me how our company after it is materially better than our company before it. And so to your point, if one marketing channel is really effective, you don't have to be in another marketing channel. There's nothing that says we don't have to be on TikTok. We should only be on TikTok if that actually benefits the company.
Exactly. What I like to say is how you build your business is not what people tell you. It's what your business tells you.
Exactly. Yeah. Wherever the money is coming from, that's a good place to go. If there isn't money coming from it, it doesn't matter if other people have succeeded using that strategy or if it's the cool thing to do, it doesn't matter.
Yeah. Like we said, like looking back on the data and you see, all right, acquisitions are a cheat code. You see, all right, we bought this last business and it worked really, really well. Why did it work well? Number one, what was the business? What was it? Are they direct competitors? Were they indirect competitors? What was the audience? Like, did we run it parallel? Did we merge it into our previous business? How did it work? Like, to reverse engineer it to get as close as you can to a similar acquisition next time, if not better. So, but first though, from day dot, say you've got a company where they're looking at thinking about starting acquiring, but they don't know where to start.
Yeah.
What sort of examples would you give on how a one business, maybe a team of 5 to 10 contractors or some full-time, would go and build out an acquisition strategy for the first acquisition to learn from, to rebuild it again for the next one? What are sort of things they should be asking?
So first and foremost, why are you doing it? And speaking as an M&A professional who spent my whole career doing deals, I always start with the assumption that a deal is a bad idea until it's proven to be a good idea, because there's a lot of pain in M&A. It's super risky, right? You hire somebody, you can fire them. You spend some money on a marketing channel, you can stop spending money. You do an M&A transaction, that money is gone, you're never getting it back, and you've made a big commitment to a product, a strategy, a brand, a direction, a team. I always start with, nobody should ever start by going, let's do some M&A. M&A is a solution. It's a hammer that hits certain nails very, very well. So the question is, what's your nail? So what is it that you want? And then I would always compare it to build, because there are very few M&A transactions that don't have a build alternative. If somebody has a unique patented widget and nowhere else on the planet is there anything other than that widget, yeah, your only choice is buy the company or not buy the company. But 99 point something % of M&A transactions have a build alternative to them. So I start with, what are you trying to achieve? Are you trying to get to a product faster? Are you trying to expand into a new market? Are you trying to add humans and you want to add a good team that's already there? But what is it you're trying? Are you just trying to create economies of scale? Those are all good reasons to do M&A, but understand why. You don't start with the deal. That's always tempting, right? It's like if I walk by a convertible 1960s Mustang, I suddenly develop a need to own a convertible 1960s Mustang. I hadn't been thinking about it before, but then I saw it. And then I have an argument with my wife. So I start with, what are you trying to achieve? Number one. Number two, be honest about the build alternative, because you may not be able to find an acquisition that you want, or you may not be able to find one at a reasonable price. So at least have your comparison available to you between build and buy. And then what are the characteristics of the target that will achieve your goal? So a good example would be if what you're really looking for is another product. Well, that tells me that you really care about certain parts of a target and you don't care about others, right? You care about the data you're going to look at. To our conversation about data, the data you're going to look at in this target is customer satisfaction with the product, feature functionality of the product, the addressable market of the product. You won't care about a bunch of other stuff. So going through that journey of what is it we want? What are the characteristics of that thing, right? And then map those against the target universe. And hopefully, if you've gone through that journey, the other benefit is it will have contracted the universe dramatically. Because saying I want to buy something, I don't know the current data, but there are something like 3 million companies in the United States. So saying I want to buy a company, you will never find the target that way. You have to compress the target set to a point where it's actually somewhat manageable. So you compress it by identifying what are the characteristics of a target company that meets my needs, what's the size that I could digest and provide capital for, and hopefully that starts to get you down into a world where you can actually start to investigate.
Yeah, I love it. So let's throw out some examples of like, what am I trying to do to grow my business, and would an acquisition work or not? Would it be, you mentioned product, purchasing, I know software companies purchase other software companies to add products to their and services to their software. You can have just general like e-commerce businesses that want to increase their customer lifetime value by either buying the audience of another company prior to the purchase a pre-product to what you already have, or purchase a product after, so on sell after they've bought your products as well, as an example. Do you want to throw in some other ones as well?
Sure. Yeah. So I'd say there's a whole bunch, right? You can basically dissect all the components of a business, and you could want to enhance any of those components through an acquisition. As you said, you could want product, and you could want product for multiple reasons, right? It's complementary to your product. It either creates a bigger sale or it creates a longer sale, right? Or 1 + 1 = 3 is the ideal, where this product plus this product makes something that is unique, that differentiates it from all the other competitors. And then there's various forms of product. There's technology as a product, there's data, there's content as a product. So there's all kinds of different product. There's even humans as a product if you're talking about professional services.
Exactly.
Then there's acquiring customers, right? So you may not be that, and I've seen people buy identical products where they're going to retire the product, but they want the customer base. They want the existing revenue. You could be acquiring a team. Now that's a relatively expensive way to acquire a team. So I find that it's somewhat rare that you're doing just a pure acqui-hire, unless the company is pretty distressed, because otherwise you can't justify paying such a premium when you could go hire humans the old-fashioned way. But I will say, we're talking about individual items. Oftentimes, an acquisition is 2 or 3 of them together. So
Right.
My primary motivation is product, but wow, that's a really great team, and they're strong in places that I'm weak. So that's an additive reason. So I'm buying the company for this reason and this reason. Geographic, expansion in terms of customer footprint in a bunch of different ways. It could be into a new geography. It could be into a new vertical. I sell to oil and gas. I want to sell to water companies. It could be into a different segment of the market. I'm SMB. I want to go consumer, or I want to go enterprise. So there's a variety of different things. And that's why I say, instead of starting with, this is the company I want to buy, I start with, if I had this capability, if I had this thing that's in a box, my company would grow faster, it would be more profitable, it would be more defensible. But you have to have that logic chain that says, if I get this thing, here is a very definitive outcome for my company. Then you determine what the thing is. And I think of that as a strategy process. That predates M&A. I haven't even decided on M&A. I've just decided I need a complementary product that will extend my life of customer. Okay. And then what is that product? And you start to refine it, because it's not just what that product is, what feature functionality does it have, who does it sell to right now? Because under the strategy you just threw out, I want it to be selling to my customer type, because I'm going to attach the two together.
Exactly.
So it's all those kinds of reasons for doing a deal. We haven't even gotten to selecting the right target or diligencing it and things like that. this is a precursor that, number one, will make it physically possible for you to find a target, because you can't find a target if the target is everybody. And number two, all of the things that we just talked about feed directly into due diligence and integration planning. They are the basis on which you can't do good diligence if you don't know why you're buying the company. You can't figure out how you're going to integrate it if you don't know why.
Yeah, diligence is obviously the last part. Similar to what you said, when I talk about diligence, I talk about similar to what you said before is like, you shouldn't just buy it. You shouldn't prove a business a good investment. You should prove it's a bad investment. If you can't, then you must buy.
Exactly. That's, you look at all the different ways you could achieve the same goal and determine that they are all inferior to the acquisition.
Yeah.
Absolutely. M&A is like surgery. It's not something that should be undertaken lightly. If there's an easier alternative, you should absolutely do it. But in some cases, surgery is phenomenal and incredibly effective.
Yeah, absolutely. It's definitely something to avoid if you don't have the capacity. But if it's 1 + 1 = 3, and you do that twice a year or once a year, depending on what capital you can raise, then you can outbeat paying for cold clients. For example, I like to talk about, you've got a marketing budget and you want to grow the business, or you've got capital and you want to grow the business. Well, you can go and market to, cold audience and try to convert cold who don't know who you are to purchasing your product. But to do that, you have to build trust. But somebody that's already bought a product from you or bought a product from a company is going to already have trust there, because the trust is already proven with the act purchase, right? So somebody that's already purchased something is a lot closer to another purchase and increasing the customer lifetime value. And you can literally buy that trust.
Absolutely. Yeah, it's a good point. You're right. It's one of the characteristics I didn't mention is it's implicit in customers. If you have customers, but brand, right?
Yeah.
You can buy that trust. You can buy that track record. You can buy that goodwill. So yeah, there's a lot of benefit to acquiring an existing business as opposed to just saying, well, I'll build it from scratch.
Exactly. Then once you kind of get to the point of like, all right, I see I need to buy an audience rather than build an audience. And it's going to make more viable sense, because I can see there's a bunch of these companies out there that have that specific audience. And the benefit is that they've already got a product that is similar to mine, and it is a pre-purchase or after purchase. It can be upsell or downsell. And they've got team, and you got like 3 different things. You're like, wow, okay, so my ROI on my capital for acquiring a business is going to be better than what I can convert with even like a good return on ad spend, right? A great ROAS.
Yeah, absolutely.
Then you go, how much can I afford? How do companies work out what they can drum up in capital and or finance and to finance the deal?
So, and then there's 2 layers to that question. The first is, how much should you afford? In other words, what deal makes sense? And it's important to differentiate between the market value of an asset and what it's worth to you. So every asset has a estimated market value based on a bunch of different dynamics. And the reality is you should buy a company when it's worth more to you than it's worth to the rest of the market. So first you have to establish that how much it's worth to you. And that's going to be, in effect, a financial projection issue. This is where the strategic CFO comes in, because you have to do the 1 + 1 = 3 calculation. And you have to, it's a hard calculation because you're not just magically putting these 2 things together. First, you're going to pay a bunch of money to purchase the business. Or, maybe you won't. Maybe you'll get it for equity, but you're going to give something away to get the business. And by the way, that equity is worth something. Then you're going to invest in integration. You're going to invest in creating that 1 + 1 rarely just magnetically comes together. So there's both time and money and distraction associated with doing that. And so you have to model all of that, and then you model the 1 + 1 = 3. And there's sort of 2 ways of looking at how much can you afford to pay. The first one is, how much more cash will you make as a result of this transaction? And you can sort of discount that back and say, okay, well, over the next 5-7 years, I'm going to make this much more cash, which is worth this much today. That's how much I can afford to pay. The other way of looking at it, and a lot of this depends on your strategy. Are you planning on keeping this? Is this your family business and you're going to keep it forever? Or are you on a journey to be sold? If you're on a journey to be sold, then the other way to look at it is, this is how much my company is worth now. Once my target is fully integrated and I've gotten all these synergies and I've gotten the 1 + 1 = 3, how much is the combined company worth? The difference between those two numbers is what I can afford to pay and be neutral as a shareholder, right? I would be happy to be a shareholder of this company, and I would equally be happy to be a shareholder with a similar shareholding of the merged company. So you figure out that sort of math, and that tells you, in theory, how much you can afford to pay. And then my attitude is always, I discount it pretty significantly because there will always be screw ups, right? Integration won't go to plan. All my visions won't turn out. And so you should never pay $1 less than what it's worth to you. You should probably pay 50, 60, 70% of what it's worth to you to ensure that even if you overshot your projections, you're still making money. It was still a worthwhile exercise. Then the second question you asked was, the second angle is, how do I get the capital for this? And I would say there's a couple of different sources. The first is to just look at your own balance sheet, right? Now, look at whether you have the cash. That's going to be the cheapest cash. The second layer is, can you borrow? And it's easier to borrow based on your current business. You already run the business. You already own it. That's a much easier borrowing conversation. But sometimes that won't get you all the capital you need, or it won't get you the rates that you want. And so then you have to open up the can of worms of going, what you're really borrowing, you're lending against is the combined business. But now you have to explain to a lender, not just your business, but 1 + 1 = 3. What does this combined business look like? And a couple of thoughts on that. One is, that's a tougher journey. Number two, it can be dangerous in your deal because in order to do that, you have to share information about the target company. In order to share information about the target company, you have to get their approval. And you then have to expose to them that you don't have all the money right. So, which can put the deal in danger. So it's something to consider if you think you can borrow. The third avenue is equity, which is sort of the same logic, which is you can go to somebody and say, would you like equity in my company? Or you can go to somebody and say, would you like equity in the combined company? The upside to the first one is you don't have to expose any information about the target. The downside is that you're presumably worth a lot less, and you may not want to give away equity at that kind of valuation. Lending has become more and more viable for small deal M&A. It used to be that lenders shied away from small transactions 20, 30 years ago. Now, I know lots of lenders that will lend on 1 million revenue, 1.5 million revenue businesses, no problem, right? They're actually less concerned with size, and they're more concerned with track record. So if your core business has been around for 3, 4, 5 years, and you have a nice steady track record, and then we can get into all the financial characteristics, because obviously if you have long-term contracts, if you have larger and more creditworthy customers, all of that feeds into how easy it is to get financing. But there are a surprising number of different financing sources, from all the way from traditional banks to venture lenders who maybe take a small amount of equity as part of the deal, revenue-based lenders that are lending on your revenue streams, other kinds of asset-based lenders. So there are a lot of different paths. In my experience, if you have a solid, stable business, and if the business you're acquiring is also sort of stable and somewhat predictable, you should be able to get a fair amount of financing. Probably not 100%, because a lot of lenders like to see that there's some equity coming in, but you should be able to get a fair amount of financing. Where it's tougher to get financing is effectively on what look more like venture deals, which is not a matter of size, but more a matter of predictability. So as an example, if you're buying a company with a technology and zero revenue, that's harder to finance, because they have to believe that somehow those people weren't able to sell the product, but you will be able to sell the product. And you can provide lots of explanation and evidence and stuff like that, but that's a harder sell for a lender, because lenders are naturally risk averse. On the other end of the spectrum, if you have a business with Fortune 500 customers that have renewed multiple times, and the target you're buying has a similar dynamic, that's incredibly attractive from a lending perspective, because the risk is so low.
And if you've got a solid, stable business over 5 years yourself, that 1 + 1 = 3 is easy to sort of build out in a business plan for, say, maybe SBA.
That's right. Exactly. Yeah. And there's a lot of complexity to SBA loans and venture lending. It's a little bit opaque because these tend to be small organizations that nobody has heard of, but it's well worth investing the time and finding your way to those different lending alternatives.
Yeah, I love that explanation. It is super important to be able to understand what you sort of can finance. So when you go out into the market to buy, you're like, okay, this, you can say no. You're not stuffing people over by, doing DD and wasting
Absolutely.
people's
Yeah.
time and
Yeah.
stuff
Yeah.
like that. It's pretty.
100%. No, I would have all those conversations. Now, if you're trying to finance based on your business and the target, you will never get a really solid commitment for a conceptual target. But you can still get somebody who says, look, I understand your business. I like your business. I'll finance a certain amount on your business. And if you have a target and you show it to me, that'll increase the amount that I'm willing to finance. So at least you've had sort of 60, 70% of the conversation with that lender. The other thing I'd say is, especially for small company lenders and especially for venture lenders, there's a significant amount of diligence on the management team, on you personally, right? So if I'm lending to a Fortune 100 company, I don't care who the management team is. I've got their financials. I'm lending to company X. The smaller you get, the more I care about the management team. Do I trust them? Are they credible? If you think about the spectrum, there's investing in a Fortune 500 company and there's investing in a startup in a garage,
Or a
right?
person. Yeah. You're basically
Which is
investing in a person.
basically two
Really.
people on
Yeah.
a desk.
Yeah.
Exactly.
Yeah. Yeah.
So as you move from this side of the range to that side of the range, who you are, how much I've gotten to know you, do I trust you, becomes more and more important. And so my advice would be anybody who is thinking about doing an acquisition to a small business, think about your financing sources well in advance, line them up, start to have those conversations, right? Meet with a few venture lenders, meet with a few traditional SBA lenders, establish a
Absolutely.
relationship, invest the time so they at least can say, I know Jared, I've talked to Jared a bunch of times. Jared's a really good CEO. I'm comfortable with him. I know their business. I'm comfortable with that business. I don't know the target yet, but I'm comfortable that Jared and his team know how to diligence that target. So you've sort of gotten me most of the way to a decision, and the only empty piece is going to be the details of the target, but that's much easier and faster for me to digest.
Absolutely. Absolutely. And yeah, I mean, you first need to know what, like you said, the step one is work out what's the problem you want to solve with M&A. Like, how do you want to grow your company? And that's have that sort of loose strategy. And then your strategy will also change a little bit once you work out your capital that you can use to acquire a business. And then you can basically go off to the races. And then from there, when you're on the search, like, how are you typically searching? Are you using a contractor, giving them a specific buy box and they're out there? Or are you doing this yourself? Or, I mean, you
So
got a little bit of it. You got a network, right? Obviously, like this is what
yeah,
I do with my network when I'm buying for people. But how do you typically go about it?
So I'd say it depends on the target universe.
Yeah.
So if you are targeting a space that you already know very well, then I think network gets you there, and it should get you there. And network's actually really valuable because network is effectively a free layer of diligence.
Yes.
If my friend Jared sends me a company that he is at least somewhat familiar with, I'm sure it's not a terrible business because he wouldn't have sent it to me. So if you're acquiring in your space, right, your industry sector, your size range, I always prefer network. And the other thing I'd say is I don't think of network in the way people often do, which is I'll talk to other deal makers in the space, because what I need from them is not any kind of M&A expertise or even whether the company is available for sale. What I actually need is somebody who really understands all the little companies in the space and the characteristics of those companies. So as an example, one of my best sourcing tools when you're operating in a space you already know is go to a conference, and then find salespeople, your own salespeople, other people's salespeople, buy them a couple of drinks at the bar, and ask them who they're hearing about when they're with their clients. Because if the client is saying, this is a good company, that's a good company, I've used this product, I've been thinking about using this product, it's great diligence. So you don't need an M&A person to find targets. You need an M&A person to execute a transaction. But what you need to find targets is somebody who knows all the companies in the space and knows their reputation, knows their product, hears things about them. So yeah, I'm a big believer in network. Where network fails is where I'm trying to expand into a new space. And usually that new space means a new customer type often, or a new geography. So, my network in fintech is pretty strong in the US. I have a little bit in Europe. I have basically nothing in Asia. So if I'm looking to add a fintech player in Asia to my fintech company in the US, my network is going to be weak, anemic at best. And so that's where I go and look for help. What I'll say is, I think that you can go to business brokers. Number one, they can be expensive. Number two, they will find companies. They will probably be better at finding companies and identifying whether or not they're potentially for sale than they will in evaluating product or brand, right? Because that's not what they do. So I actually think for initial sourcing, if you can find somebody who is an industry player in the space, that's sort of a little bit of a cheat code, because they will often do it for free because it's interesting to them and they like talking about the industry. Maybe they hope that you'll bring them on as an advisor or a board member afterwards, which you might. Where I think it's useful to use brokers is, number one, where the target pool is very large. So I can't get to lots of players. And so this person actually does some of the labor of filtering, because the referrals from my network get me a bunch of email addresses, but they don't do they're not going to do the first call, right? My friend Jared isn't going to filter for me.
There's no
They were doing me, he was doing me a favor just sending me an email address.
Yeah, exactly.
So, and then the other thing that business brokers are good at is, as I said, identifying companies that are for sale versus aren't for sale. Again, something that your friend Jared isn't going to do. And depending on the space, that's an easier or harder exercise. But it's especially valuable if you're dealing with a lot of founder-owned businesses. Because private equity-owned businesses or corporate-owned businesses, the answer to that question is an absolute yes or no. Instantly, right? If you have a private equity fund and you have an asset, you're either willing to entertain offers or you're not. And if you're a corporate and you have a subsidiary, you're either willing to sell it or you're not. Period. Where it gets harder is founders, where the answer is often a very emotional one and a very subjective one, right? So maybe I would sell it. Who am I selling it to? What are they going to do with it? What about my team? I don't know. Would I continue to have a role? All that kind of stuff. And that's where having a business broker can be incredibly helpful, because they get to be the therapist for that series of conversations, as opposed to you.
Yeah. Which is so valuable. Like, that's what kills most deals, is the emotions from
percent. Well, we haven't even talked about, this is just sourcing. Once you start negotiating a transaction, everyone feels their feelings very hard, and having a independent third party in the middle can often be very valuable. You could sometimes use a lawyer. You can sometimes use a board member or an advisor. But I've found that when you're dealing with founder-owned businesses, having a little bit of a buffer, especially for the tough conversations, can be really helpful.
Yeah. This is the beauty of an M&A advisor, really. It's like managing the transaction and making sure people are always connected in communication and preempting their feelings, and sort of having that conversation with them before those feelings come up, and sort of share those expectations. Like, this is how long it could take. This is how you're going to feel when you like this last little document that you need to send over. And they're like, they've asked me so much, what's their skin in the game? Like,
oh, yeah, absolutely. Well, I think the M&A advisor plays a bunch of critical roles, especially for people who have not done a lot of acquisitions before. My argument is that they can be helpful in sourcing, but I wouldn't totally depend on an M&A advisor. I don't think of M&A advisors as like dumb sourcing machines, especially in an era of technology and LinkedIn. That's actually not the big value they bring. They may source, but the big value they bring is all that negotiation stuff, all that emotional stuff you just talked about, having an understanding. They may not understand your business in detail, but they've seen this movie 150 times before, so they know where due diligence often fails, where integration planning often fails, where people often have over-optimistic financial projections, where they often have trouble getting their capital lined up. It's all of that kind of stuff that, unless you've done 20 deals, at which point you have a corp dev team, you don't know. M&A is not for training wheels, right? It is a very scary place to learn. And so that's where having an advisor who, as an example, even if they know nothing about your technology, they know enough to go, have you looked at their code base and your code base and evaluated how complex it's going to be to integrate the two? Have you looked at whether they're using open source code? Because that's a liability risk. Like they may not understand a lot of the details. Or have you looked at their customer renewal rates? Have you looked at their customer contracts? Have you talked to their customers? And make sure to talk to not only happy customers, but churned customers. It's stuff like that where even if they don't understand your business in depth, they've now seen this so many times and they've seen the aftermath that they can warn you off of stuff.
They don't need to understand code. They just need to understand how business works. And like I said, preempt, these are the biggest risks in acquisitions and the biggest risks in typically any technology acquisition, any e-com, any media business acquisition. This is what you need to check for any e-commerce business,
Absolutely. Yeah. And, I think the other thing they do well, and this gets back to the emotions, is a good M&A advisor not only tells the other side the truth, but tells their client the truth. So they tell the founder of the company you're trying to buy, look, your business is worth about this much. I know someone offered you more in the past, or you heard stories, but I'm telling you, this is what I do for a living. And the flip side is they'll say to you, Jared, that offer is not going to get this deal. Unless this guy is an idiot, you're underbidding. I'm glad to send that message if you want to, but I can already tell you what the answer is going to be.
Yeah, and let's not wreck our reputation.
It may blow up the deal.
Yeah, let's not just wreck our reputation and everybody else finds out that they're just trying to just get a bargain and they're just kicking tires and taking data and information. Yeah.
Yeah. So the advisor they've just been down this road so many times that they've seen a lot of the different outcomes and they can warn you about them. And the good news is you can then decide whether that's relevant in this situation. So they may say, look, we have to check the IP on the brand. I've seen a lot of situations where people don't own the IP and you go, actually, we're going to trash the brand 3 seconds after we buy the business. So thank you, but that's not relevant here. But it's that mesh of, I've done this 1,000 times. I understand what I'm trying to accomplish in this specific transaction. You put those two together and you have an effective team.
Yeah, absolutely. Yeah. And that's why having an advisor basically from the start can help you with, you might come up with an idea of like, how do I create that 1 + 1 = 3 strategy? And then you get an advisor in and say, well, yes, you can do it or this, but what about that? And maybe they can get 1 + 1 + 1 = 5, and build out a better strategy. And you actually get a better ROI for the capital you spend in a company that you acquire versus like, yeah, I can just get 1 + 1 = 3. But what if you get an advisor that gets you like so much more? And then they help you merge and then they help you go again and they become your main guy or main person to keep acquiring. And that's what an M&A advisor that's what I want is, I want to work with people that want to do multiple deals and we build out great companies because it's great for my business. I don't have to go out and advertise and I get referrals and then I help you grow over the longer time and we create a great relationship. You make a ton of money. We make money. Everybody is just loving life and it doesn't need to be stressful or hard because we have each other.
Yeah. And repeat acquirers, like anything in life, you get better and better at it. And that doesn't necessarily mean you become an M&A expert, but you build the internal muscle to do. Simple example, the first time you acquire a totally new employee base, you don't know how to integrate them fast, right?
Exactly. Yeah.
The second time, you've now hopefully only tripped over a couple of the landmines because you had an M&A advisor who warned you. But by the second time, you've done all the stuff you need to do. As an example, if you have to build out material to explain a transition of benefits from your benefit system to our benefit system, you build that for the first deal, you use it for the next deal and the next deal and the next deal. So financial modeling or considering tax issues. So there's a whole bunch of stuff that gets easier as you do this more frequently. It doesn't mean you're an M&A expert, but at least you're an expert in evaluating your own needs as a company and then figuring out how to absorb targets. So by the time you get to the 15th deal, it's dramatically, everything becomes more effective. And you're right, the return rates are good M&A has phenomenal return rates, just as bad M&A has phenomenal loss rates.
It's so true.
The risk level is, my analogy would be, and that's why you really need to trust your M&A advisor. The mechanic you hire for a broken down old Honda Civic is not the same
as a
advisor you hire as a mechanic for your Ferrari.
Yeah.
And I would argue M&A is a Ferrari kind of decision.
Mm-hmm. Yeah. Yeah. And you've got a Ferrari, and then you got all these other luxury brand cars as well, different types of M&A advice for different types of sectors.
Absolutely. But it's all high risk and high return. And so not getting the help you need is penny wise and pound foolish.
Yes.
Absolutely. Like, I'm not saying whether anybody specifically needs any kind of help. In my experience, unless you've done a lot of M&A, you need somebody who's advising you on M&A. From a deal perspective, you need a lawyer, maybe you need a tax advisor. But my point is, if you're spending $1 million, $2 million, $3 million, saving $20,000 or $50,000 or $200,000 is probably not a wise decision.
Absolutely. And also, as a founder or somebody that's got, is going to buy something for that range between 1 to 5 mil, they're typically not going to have a big team. They're doing it themselves. You're better off not wasting your time trying to do it yourself when your time is best spent in one certain activity in your business to get growth.
Yes.
And distracting yourself and taking yourself away from that is just silly. For example, even like when I'm buying any sort of property, I'm not going to try and outbeat somebody that is a buyer's agent that's been doing this for 20 years.
Yep.
Just here's the money. They're going to buy me the deal for the cost price cheaper than what I'm paying them for a fee anyway, which is what an M&A advisor does too. Yep. So your fee is paid for, but you get, decades of experience.
Well, and I'd say, yes, they'll negotiate down the price, but I actually think that's the greatest value that an M&A advisor brings you is, number one, helping you avoid a bad deal, which would be catastrophic. And number two, executing a good deal the right way. And part of that is getting the lowest price possible. Part of it's getting it done faster rather than slower. Part of it, to your point, is minimizing distraction. You'll never eliminate distraction because the buck stops with you. The M&A advisor can't do everything, but they can do the bottom 80%. So it's going to be stressful for you, but there's a difference between it being a distraction and basically taking you off of your day job. And that, you're absolutely right. You want to avoid that because your core business failing will also doom the M&A transaction anyways. So yeah, there are a bunch of ways that getting help is critical. And it's why I'm always frustrated when people sort of treat M&A as just another business transaction. I'm like, no, it's a specialty. As you said, you wouldn't go and try to negotiate a house purchase. You wouldn't try to inspect your own house. Well, unless you happen to have that set of skills.
It's very rare.
Yeah, this is a high stakes place where you don't want to, it's the same reason I'm never going to have, even if there's a 50% discount, I'm never going to have my dentist do heart surgery on me.
Yeah, exactly. It's a great.
And I'm certainly not going to do heart surgery on myself.
Yeah, exactly. I love that. Let's leave it with that, Michael. Thank you so much for coming on. Where can we send people to check out more about what you're up to?
So I'm on LinkedIn, obviously, and then michaelfrankel.com, which is just my name.com, has the books I've written and some of the podcasts. I'll put a link to this one as well when it comes out.
Awesome. Thank you. Appreciate that. Everybody is listening. Thank you for listening. Thank you so much for your time, Mike. And yeah, I hope everybody enjoys it, and I'll see you in the next one.
Excellent.